Welcome to the Stock Market Palantir. Today we are going to talk about MBA.
In this case it's a critical study in corporate reinvention versus, frankly, some pretty aggressive financial engineering. The sheer complexity of this reverse merger, taking the distressed biotech, CheckTap, and swapping it entirely for MBAI, it really demands a forensic analysis.
It really does. We're discussing MBAI, the resulting entity. And I think the central question we have to answer for investors is this. Does this profound corporate transformation represent a successful, strategic pivot into the high-momentum embodied AI sector? Or is it primarily a financially engineered vehicle just structurally burdened by fatal risks and a disastrous history of shareholder dilution? My position is that this merger successfully monetizes the Nasdaq listing status, creating viable speculative potential in a sector that's just absorbing massive amounts of capital right now.
And I maintain that the foundation is precarious. The combination of an unstable capital structure, ongoing and persistent regulatory uncertainty, and a really fragmented market microstructure suggests overwhelming risk. I think the entity is fundamentally unstable, suitable only for the highest risk speculators betting purely on narrative momentum, not any kind of underlying stability.
Well, the MBAI merger, which was defined by that aggressive 90-10 equity split heavily favoring the new entity, was the necessary, strategic, and, frankly, the decisive action required to shed the liability of that zombie biotech identity. I mean, CheckCap wasn't just struggling. It had reported a massive net income loss of $25.15 million over the trailing 12 months leading up to this deal. And that was all following the definitive failure of its C-scan technology. So that 90% allocation to MBAI equity holders wasn't arbitrary. It was the cost of purchasing access to the public markets and, critically, allowing the legacy company to just cease its primary loss-making operations immediately.
It was certainly an action for survival, I'll give you that, but survival built on a history of documented destruction. You point to the shareholder support, 98.01% approval, as evidence of strategic approval. I see that completely differently. That vote signals resignation. It suggests the existing shareholder base was so desperate to avoid the absolute loss of a formal liquidation that they accepted any deal that offered an external narrative, even one as, divergent as AI, just to avoid insolvency.
But acceptance of an alternative is still a strategic vote. This transaction successfully decouples the equity's valuation entirely from legacy medical device fundamentals. It instantly re-anchors its valuation to the highly speculative potential of AI and robotics, which is, without question, the dominant, most capital-rich market theme of 2025. It's a brilliant financial maneuver to capitalize on market sentiment.
I agree it's clever financial maneuvering, sure, but we have to look at the foundation this new AI narrative rests on. It's fundamentally unstable because it's built on a documented catastrophic history of value destruction. Before we even get into the new entity, we have to acknowledge the sheer cumulative impact of the reverse stock splits that CheckCap executed. The 1-for-12 split in 2018, followed by that crippling 1-for-20 split in 2022. That is a 99.6% cumulative reduction in share count for any long-term holder. That's a clear pattern of catastrophic capital erosion right before this AI pivot.
Those splits, while painful, were statutory requirements simply to maintain their most critical asset, the Nasdaq listing, which, brings us to what you call strategic dissonance. You highlighted the acquisition of those ghost kitchen franchise rights in New Jersey, a move completely unrelated to biotech or future AI ambitions, where CheckCap issued nearly 1.2 million shares to Perea LLC to finalize that deal.
Right. And that is a critical red flag. It demonstrates a severe lack of fiduciary integrity and strategic focus in the months right before the merger. Why are you issuing shares for fast food franchise rights if your impending focus is supposed to be world-changing embodied AI technology?
I would argue that it was a very specific tactical move. It was designed to address an immediate structural compliance failure. The board was scrambling. They needed any tangible asset or revenue stream to satisfy some very specific, low-level Nasdaq listing requirements in the immediate short-term revenue.
that the failing C-Scan product just could no longer provide. So the Ghost Kitchen acquisition was essentially a Band-Aid, a disposable asset designed solely to bridge the gap and maintain the listing just long enough for the much larger, transformative MBAI merger to close. It was a means to an end. The asset itself is basically vestigial and irrelevant to the AI valuation moving forward.
That assumes the management is capable of focus strategy, which their history doesn't really support. Now let's talk about the single most urgent structural vulnerability facing the stock right now, the authorized reverse split.
A transition that moves us neatly into the future capital management requirements.
Indeed, so shareholders approved authorization for a new reverse split at a ratio between 1:14 and a staggering 1:100. That is an extraordinarily wide range. I find an authorization up to 1:100 to be exceptionally aggressive, even for this kind of environment. It sends a chilling signal. Management is profoundly fearful that the stock could rapidly trade in the pennies without drastic intervention, creating an immediate, massive, and destructive drag on current holders if they execute at the high end. It also creates a systemic risk, because if you raise the price of the stock to, say, $5 or $10, it immediately becomes marginable and significantly more attractive for institutional and predatory short selling, which just restarts the whole downward spiral.
I see why you emphasize the risk, but I would frame the authorization as a prudent, even essential measure. It's for ensuring long-term institutional viability and NASDAQ compliance. The primary strategic intent is really twofold, and both are critical for the post-merger trajectory. First, it ensures the new entity trades comfortably above that $4 initial NASDAQ listing requirement, which is essential to maintain status and attract a higher tier of investor. Second, and just as important, it allows management to reduce the bloat of the outstanding share count, which was around 5.5 million shares pre-merger, to a tighter, more concentrated float. A tighter float is inherently easier to manage and to move aggressively on positive news, allowing the AI narrative to gain real traction without being diluted across millions of legacy shares.
But the specter of that 1-to-100 split remains an active deterrent to genuine long-term capital. I mean, no responsible fund manager will take a position knowing management has armed itself with such a weapon ready to execute another 99% value destruction event if the price just slips below the compliance threshold. The authorization itself acts as a persistent ceiling on any kind of sustainable demand.
That risk is priced in. Let's shift focus away from potential future dilution and examine the current trading environment itself, the market microstructure, because the way the stock is trading suggests sustained, sophisticated interest, both bullish and bearish.
You see tight spreads as liquidity. I see market fragmentation that obscures true price discovery.
Well, let's look at the data. In the period immediately following the merger closure in late 2025, the annualized interest rate to borrow MBAI shares was 14.78%, and it was categorized as hard to borrow. Now, that high borrow fee indicates sustained equilibrium demand for short exposure among sophisticated bears. That high cost of carry is significant. It acts as a constant drag on short sellers, requiring the stock to drop significantly just to cover the cost of maintaining their position. If there's any positive momentum, those shorts are positioned for a highly volatile move upward.
That's a compelling argument for speculative volatility, sure, but let's scrutinize the volume itself. The off-exchange short volume ratio at 48.35% is highly relevant, but its interpretation is key. You might see it as a proxy for substantial retail buying interest being internalized by wholesalers. I interpret it as evidence of dangerous market fragmentation and phantom liquidity.
What do you mean by phantom liquidity?
I mean that a nearly 50% trading ratio implies that a huge proportion of volume isn't contributing to visible price discovery on the lit exchange. The mechanism is that retail orders are being executed internally against wholesaler inventory in dark pools. This process segments liquidity. It creates the illusion of tight spreads and depth, but it fundamentally obscures where true institutional price discovery is happening. If the vast majority of retail buying is internalized, it limits the pressure required to drive the stock higher on the lit exchange, where the institutional buyers who determine long-term valuation are looking. I'm just not convinced this highly fragmented, internalized trading environment can sustain genuine long-term valuation based solely on an AI narrative. It makes the stock easier to manipulate.
But that dynamic only works, however, if there is no significant positive news. The fragmentation means that when a catalyst does appear, the resulting short squeeze or retail rush is often more exaggerated, precisely because the underlying pressure has been building off exchange. We both agree on the mechanism, internalization. We just differ on whether it presents opportunity or a fatal structural weakness.
Fair enough. But regardless of microstructure, we have to address the most pressing binary risk that trumps all others: NASDAQ compliance.
Absolutely. We both acknowledge that the most urgent threat is the violation of NASDAQ Listing Rule 5550B1, which requires a minimum of $2.5 million in stockholders' equity. The legacy company received a formal notice of non-compliance on September 3, 2025.
It's the scarlet letter of the balance sheet, a formal public notification that the entity is not meeting basic financial standards.
I would stress, though, that the MBAI merger, specifically the injection of the new entity's substantial assets, is the only curative strategy. This strategy was explicitly engineered to satisfy and cure this deficiency. While it's pending verification of the audited pro forma financials required by NASDAQ, which is really just an administrative bottleneck, the strategy is structurally sound and provides a clear, defined path to removing the compliance risk.
But the market reality is harsher than the strategy on paper. The persistent display of that non-compliant with NASDAQ requirements alert on market data feeds, visible even after the merger closed in late November, is the immediate overriding problem. Many institutional charters and investment mandates strictly prohibit holding stocks with non-compliance flags, regardless of management's intent to cure the issue. This creates an artificial, persistent ceiling on demand. Until NASDAQ regulation formally clears that flag, the risk remains existential. Either compliance is verified and the stock moves on, or the stock faces delisting to the OTC markets, which is ultimate financial oblivion for this ticker.
We are discussing a high-risk microcap environment. Binary outcomes are inherent to this sector. They're often aggressively priced in. The fact that the stock is trading comfortably above the $1 minimum bid price requirement, even post-merger, shows that the market is willing to wager on the success of the compliance cure. They are betting that the injection of the new entity's assets will be verified, the flag will be removed, and that will unlock substantial institutional interest.
But the fact remains that if that clearance is delayed or if the initial volatility pushes the stock back toward the dollar minimum, management has already equipped themselves with the nuclear option of the 1-to-100 reverse split, which will just restart the cycle of catastrophic shareholder value destruction. The downside is clearly defined and immense. So, to summarize my position, while the corporate pivot to the AI sector is an undeniably clever move to monetize the NASDAQ listing, the fundamental risks are just too acute and too structural. The history of catastrophic dilution, the threat of that potential 1-to-100 split, the persistent regulatory overhang, and a trading environment dominated by internalized sentiment, it all means MBAI is suitable only for the most aggressive high-volatility speculation, dependent solely on narrative and not on sustainable financial fundamentals.
And I fully acknowledge the significant historical and regulatory headwinds that characterize this stock's legacy. However, the successful execution of this cross-border merger has fundamentally changed the entity's trajectory. It has transformed it from a failed biotech into a highly liquid vehicle, and we saw that with the high volume and tight bid-ask spread on the ticker change day, that is now decisively aligned with high-growth sectors. This repositioning presents significant, though certainly risky, upside potential for those who can tolerate that volatility and who believe in the curative power of the new AI assets. And understanding both the intricacies of the strategic restructuring and the modern complexities of market microstructure, how off-exchange liquidity truly functions, is really essential for anyone trying to navigate highly speculative microcap environments like MBI.
We've broken down the tension between the immediate opportunity presented by the AI narrative and the structural hazards posed by dilution, compliance risk, and trading fragmentation inherent in MBAI.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.